Well, good afternoon. It is Tuesday, the 21st of March, and I'm here with Michael Harding and Michael Elerath, and I'm Bill Roller. And we're doing our weekly talk about finance and real estate here in beautiful Clark County. Big things happening this week, of course, have been the implosion in terms of selected banks. Certainly, Silicon Valley Bank went away, or has been, having trouble. And then Credit Suisse announced today that it's had a shotgun wedding with UBS, and selected regional banks have been having trouble, like First Republic Bank down in California. But a lot of those are also rebounding today in hopes that the bleeding has stopped. But we'll see. So, what do you want to talk about first, gentlemen? Real estate or the Fed, or both?
Well, let's talk about, if you don't mind, let's talk about the Fed and the banking and that thing, because that encompasses more than just real estate. It deals with the economy as a whole.
Well, it's referred to as FIRE, finance, insurance, and real estate. And we've been seeing the FIRE this week. This is day one of the Fed's meeting. And actually, the market was surprisingly strong. Usually nothing happens. But today, technology was actually outperforming. Tomorrow is Jerome Powell going to school the market, and CNBC and the rest of the gang on his view on interest rates. I think the market's anticipating perhaps a slowdown, or 25 basis points seems to be baked into the Fed funds rate. So hopefully he'll do that, but it'll kind of give a more dovish guidance going forward. Kind of interesting things here that the banks have been blowing up because of their duration mismatches between their assets and liabilities. So, but the Fed has said they're gonna backstop the banks, and but they'll protect depositors, but obviously not necessarily protect shareholders and bondholders. The CS gang, bondholders and shareholders have gotten wiped out, and they're reading that there was kind of some bonds that the employees were using for compensation, and so they've been squashed to zero also. So pick your employers carefully, I suppose.
So, Bill, what do you think the long-term impact of all these banks having difficulties? What do you think that means for the overall economy moving forward?
Well, I saw one thing, that said that banks, the issue with the banks may actually kind of be the equivalent of an increase in interest rates by the Federal Reserve, which would argue for them to, start pausing a little bit, or at least not go beyond the next 25 basis points increase in rates. But never forget that banks, it's kind of a very fungible commodity, for money, and you're just gonna see a lot of the rise of shadow banking, which we're already seeing. The venture capital groups are continuing to fund their client companies down in Silicon Valley. Other folks will do the same. Back in 2008, there was a lot of real estate. There was a lot of private lending going on. People who had deep pockets, they were acting as banks basically. So we'll see the same thing.
So when you say that, and what did you call them? The not angel investors, but there was a word that you used.
Shadow banking.
Shadow bank. Are you talking like the Peter Thiel?
Peter Thiel's the venture capitalist. Yeah, he's a big one. But I saw back in 2008, a well-heeled investor who lived down in Southern Oregon was financing real estate deals. Of course, he was taking a very secured position on that, and he was charging 10 to 14%. To get to act as a bank basically. So we'll see the same thing, and the strong will survive and the weak will go by the wayside. That's kind of both the beauty and perils of capitalism. But we are seeing actually big cap tech is acting as the safe haven in this market. So last week, while the regional banks and even the giant too big to fail banks like the JP Morgans were having a hard times in the markets, Microsoft was trading up. Amazon, kind of those very deep pocketed people that, what, we don't need banks. So they were doing okay, and so the money's flowing back to big cap tech, at least for now.
Well, like you said last week, it'd be a pretty sweet deal, in my opinion, to see Microsoft buy an SVB or the Signature, or that other bank in New York that went belly up. And so I just think that would be pretty good.
Well,
overall.
Yeah, the downside is neither one of us work for the Federal Reserve, so there's certainly been that happens in Japan, where the giant keiretsus own banks, but it can't happen here in the U.S. At least not yet. But we'll kind of wait and see. Too much market power for the Microsofts and the Amazons of the world, I suppose. Even though I'm not really sure what the difference is between having Wells Fargo's and Safeways and that otherwise, but we'll kind of see. But if we get kind of to the end of a tightening regime, should be starting to see a bull market emerge, and I am starting to see it in selected groups. Semiconductor.
So you think we're headed towards more of a bull market?
Yeah. I think we're starting to see the early stages of one. And one of the ways you can tell it's a bull market is nobody wants to invest, and the percentage of people invested, bullish percentage for advisors is like at a 20-year low, like at 30%. So that's a great contrary indicator. But Mike Elerath, you said you did a little looking at the Fed?
Well, I looked a little bit at what you guys were addressing here a moment ago, and I'll call it the beauty and the beast, and the beast and the beast. The beauty of the system is that money flows into areas where it can be utilized and where profits can be made, and that is, as Bill was mentioning, more towards private lending, and that does, the beauty of that is it does push up interest rates for those willing to take the risk to lend their money. I had a conversation with Bill Silber today. Bill is the professor of finance and economics at the Stern School of Business, New York University. And he's also a member of the New York Mercantile Exchange. And Bill talked mostly about the moral hazard of guaranteeing bank deposits, which is what many are asking the Fed to do, to guarantee all bank deposits, as long as they're guaranteeing the Silicon Valley Bank and some others. And the moral risk part of Bill's conversation involved the opportunity for those lenders, or perhaps for all lenders, to take risks when there's no downside risk. So if our deposits are universally guaranteed, then will our banks take more risk? And if they do, will they lead us down the waterway and down over the waterfall with more failures? So I think that Bill made his point on that, and then his conversation was followed up with a conversation with the president of the World Bank Group. The World Bank Group is the largest known group lender to development projects in developing worlds, developing nations, that is, in the world. This gentleman named the president's David Malpass, and he stressed that excess government debt risk creates a hogtie effect with small business growth. If the debt payments are going to the government, there's not enough liquidity to provide funds for this small business development growth because the government absorbs free capital. Now, that's also, there's so many moving parts here. You know, interest rates go up, that causes inflation. The government bringing more capital in takes capital out of the market for private enterprise use, and that in itself has a contrary effect, causes contraction and slowing in the markets. And if the goal is stopping inflation, it might work. So you've got the seesaw and the yin and the yang, and a lot of confusion out there. And Bill, you usually have comments about these, I say. What do you think about that?
Well, so he was saying don't insure deposits, which yeah, well, I mean, it's a tough road to hoe because
well, it's more like don't change the rules.
Right. Well, the problem is the rules kind of change in midstream, depending on how angry the voters are. So, yeah, the whole deposit insurance thing. I mean, at least in 2008, they basically guaranteed the capital of the banks, including the shareholders, which really made a lot of people mad that they got a bailout and then, you know, took TARP money and then paid bonuses to executives. So at least this year, the executives and the shareholders are being wiped out, even though the depositors are being, you know, somewhat guaranteed. Let's hope that 90% of the deposit guarantee comes from the assets and the burned out husk of the banks that do fail.
Yeah, that 10% is still a pretty big number, isn't it?
Yeah, it can be pretty large. It can definitely add up. But yeah, well, and we've certainly seen that smaller banks tend to be overly geared to real estate. So that's where most of the issue is, especially, you know, getting tied up with an illiquid asset that may in fact be depreciating.
That's where good lending comes into play. You know your borrower and know your real estate. If you lend right, should be all right. Like Kevin O'Leary is saying that lenders, regional lenders in North Dakota are in really good shape because they know their borrowers and they know their real estate.
Yeah. Well, speaking of real estate, Michael Harding, let's talk about this year versus last year, I guess.
Yeah, Bill and Mike, I thought it would be a good time and a good opportunity to compare where we are this year in comparison to where we were last year. And, you know, to a certain degree, the numbers are kind of surprising because they're not too far off. I mean, there are some distinguishing differences between the two, but overall, it's not as bad as I thought it would be this year. This week, I should say, there were 151 new to market, 97 price changed, 183 went pending, meaning there was a mutual agreement between buyer and seller. There were 100 sold last week that completed the transaction. 56 of those were done in under 30 days. The days on market ticked up a little bit to 50 days. The average list price went above the average sold price. If you remember last week, the average sold price was above the average list price for the first time this year. And so it went back down to where the list price went above the sold price. And there was an equal list price per square foot and sold price per square foot. There was just probably some rounding that took place between the two. That's why we have a difference. So if we take those numbers from last week and compare it to a similar time frame from last year, this week's numbers were March 11th through March 17th. Last year's numbers were March 12th through March 18th. So, and last year, you got to keep in mind, things were just absolutely crazy. We were just, it was just crazy. And the thing that shows how crazy it was is if you go over to the sold in under 30 days, again, this week it was 56%. Last year it was 91.1%. And what that represents is that here today, gone today. I mean, really, because I don't track how many were done in under 7 days, meaning went on the market this week and was gone the same week or the same day in some instances. To me, those are anomalies and not something that's really consistent, so I don't really track those. But if you take a look, last year there were 242 during that week. This week rather, 154. And so, given how manic the market was last year, we're not doing too bad in terms of new to market, and then the price change, the price reduction is really what it is, and the pending and the solds. And so I still think that we're in a pretty good spot market wise. One other thing I'd like to bring to your attention is the list price last year compared to the sold price last year. You're talking nearly a $20,000 difference. And so that's how much people were overpaying for the list price. And that's what drove the market up so incredibly high. But if you look at it, this year's list price is higher than it was last year for the same time frame. And I just thought that was an interesting thing. But, it's not really indicative of too much. But it was just something that just caught my eye, because we're supposedly in a down market due to the Fed's raising the interest rates so rapidly and so frequently. But overall, we're in really good shape here in Clark County, and that's something that I feel will remain the same unless we have continued problems with the banks and the consumers lose confidence in the banking system and the lending system. Then we might have more issues to deal with that might impact the market. But overall, I think we're doing really well.
Yeah, very interesting.
Hey, Michael, I have a question for you. This may be something we could get a future answer on, if not now. But do you have any indication of whether purchasers are putting more down and borrowing less?
That is a question for lenders, and I can check with lenders that I often refer people to. On my side, that's really not some data that I get access to. But I can check with people that do have access to that and see if they can provide some information with regards to that. And so, Mike, just so I can understand the question fully, so I can present the question to them. Your basic question is: has the borrower, gosh, that's hard for me to say today. Are they putting more money down and borrowing less or financing less? Is that basically what your question is?
Yes, it is. Is the equity to loan average per purchase a higher ratio than it was? And the inverse of that same statement would be, is the loan to value ratio lower? Are they borrowing less percentage on their purchase price? And when the market's a little bit tight, and some folks would rather have a house than invest in something else, I'm wondering if perhaps they're putting a little more down to keep their payment down within their comfort zone, within the ratio that the bank likes to see, and still, therefore a little more cash coming in to the purchase marketplace to compensate for those higher bank interest rates.
Well, Mike and Bill, one thing that that they might do it. Now, that the answer might just me sitting here today without discussing it with any lenders. I think there's two parts to that question. Are there current homeowners who's recently sold their home applying a good portion of that money down to bring their mortgage payment down to a certain degree or to a certain amount, versus the first time home buyer who doesn't have an asset to sell and to use some equity to apply to the down payment. So there's two questions really. And then what I'm also curious about, based off of your question, is how many people are getting to that 20% down to avoid the PMI or primary mortgage insurance. And so if you apply less than 20% of your down payment, then you're going to have a PMI, and there's a whole complicated factor. But that's an additional payment. If you only put 3.5% down, then you got to pay 16.5% to get rid of that PMI, depending upon your loan type. So it's a great question, and one I think that deserves exploring and an answer to, because that does have an impact on the overall economy in terms of that household. The budgeting economy is what I meant to say. So that's a very valid question, and one that I'll get on.
Sounds good. Look forward to listening, hearing what you find in your exploration, Michael. Thank you.
All right, thank you.
Yeah, so you're coming into kind of your busy period here for the year.
Yeah. Next week I'll try to if I have the time, and I should have the time, I'll get some historical numbers, a 10-year trend between the number of new to markets for the month of March, April, May, June, July, and August, because those are generally the times when the market is heating up and the market is starting to cool off. From March to August is when we're really at our peak in terms of activity in a traditional, market. Now, the market has been anything but traditional the last 10 years, because 10 years ago, 2013, we were still coming out of the Great Recession of 2008, and so then, and then we had the great rate reduction due to COVID and all that stuff that created this mass hysteria in buying. So it's anything but average. So I may even go back a little further than 10 years to see what the averages are for that time frame and compared to where we are today.
Yeah, that'd be interesting. I think the averages would show it a little bit better.
Right.
Yeah, but I guess we'll continue to see if the Fed normalizes rates and everything, and kind of gets back to a normal, balance sheet, not a giant bloated monstrosity like they have been really since 2008. So kind of see with that, and hopefully the markets will kind of continue to recover. Anything else either of you would like to add for this one? We're at the just about at the 30-minute mark.
Did we discuss tomorrow's Fed meeting at all?
Well, we mentioned it, yeah, that the Jerome Powell will be, the press conference usually at 11 o'clock, and the market kind of quiets down and gets very silent as as E.F. Hutton talks and people listen.
Okay. Well, next week we'll have a little conversation about tomorrow's Fed meeting.
Yes, and let's hope we just get the 25 basis points and dovish discussion after that. So we'll see.
Yeah, that's what the bets are on. So we'll see.
Well, it'd be interesting to hear his forecast about the economy moving forward into the future. That's what I'm interested in, because if he says, well, this is just a temporary pause and we're going to take a more aggressive stance in the future, that'll be something I'd be interested to hear him discuss. His perceived position of the economy moving forward.
Yeah, it's going to be an interesting day. I know that. It's in some ways too hard to call. So keep your powder dry and lots of cash and be ready to put it to work.
Yeah.